Hi everyone, my name is John, and this is Talk Finance. Today we are talking about Main Street Capital, ticker symbol MAIN. It's currently trading at a price of $36.95 a share, and in the past month it has been hovering around $35.90 a share and $37.49 a share. Should you be buying Main Street Capital? Are you looking for dividends? Well, I think you should definitely take a look at this company. Main Street Capital is a business development company, or BDC. A BDC makes investments in various companies, typically those that are smaller in size and or don't have alternative ways of obtaining financing, such as through a bank or issuing bonds. BDCs invest for income as well as for capital appreciation, and BDCs often hold debt securities as well as stocks, both private and public, in their investment portfolios. BDCs are often compared to venture capital funds, but instead of only being open to accredited investors, they are available to all investors. So Main Street Capital invests in companies that generally don't have the ability to secure financing in traditional ways. Like I said before, like via bank loan or selling bonds. Main Street Capital focuses in the underserved lower middle market. These are companies with an annual revenue between 10 million and 150 million, and earnings before interest, taxes, depreciation, and amortization of 3 million to 20 million. Main Street Capital then takes significant ownership stakes in these companies and or received above average interest income. Since the 1990s, they have worked as a private equity alternative with over 200 lower middle market companies in a diverse range of industries including consumer discretionary, financials, healthcare, industrials, materials, technology, telecommunications, and transportation. As you can see, their portfolio is very well diversified, not just in the amount of companies they invest in, but the type of industries as well. Let's talk some more about Main's financials and dividend payouts. Main started trading on NASDAQ in October of 2007 and offered a dividend of 33 cents a share and was able to pay that until about 2008, where it started offering a more stable dividend of 12 cents a share, until 2011 when it started raising its dividends consistently as the company grew and became more aggressive with their investments. They have since raised their dividends consistently to where they are now at 22 cents a share and usually add a bonus at the end of the year of 10 cents. By the way, starting in January, they have increased their dividend again to 23 cents a share. Main Street Capital currently has a market cap of $2.8 billion. Its 52-week low sits at $31.57, and its 52-week high sits at $45.43 a share. Its trailing 12-month earnings per share sit at 3.19, and trailing 12-month PE is 11.57, with its forward PE sitting at 10.29. Also, its trailing 12-month revenue is $345 million. Is their revenue growing even in this market? Well, they released their Q3 2022 revenue and EPS. They had an expected revenue of $87 million and they ended up reporting $98 million instead. That's an increase of 12.15% beat. They also expected an EPS of 76 cents and reported 83 cents. That's another increase of 9.9%. So what are analysts saying about Main Street Capital? According to CNBC, 2 analysts gave it a buy, and 5 gave it a hold. If we go over to Yahoo Finance, we can see that 1 analyst rated it a buy, 4 rated it a hold, and 1 said you should sell the stock. I usually say look for a company with good financials that has diversifications and a stable history instead of chasing the dividend yield. But even the Motley Fool wrote an article on 2 high-yielding financial stocks to buy with $1,000 and listed 2 stocks, Main Street Capital and Prudential Financial. Most analysts have given Main Street Capital a price target between $39 and $46. I myself hold around 28 shares of Main Street Capital, making it one of my least purchased dividend shares, but I still own them, and I'm not planning on selling them anytime soon. I bought most of my shares between $34 and $40, so I don't plan on buying any more shares unless I can dollar cost average into them by purchasing more shares at a lower price. I do think the company will keep growing, but with the uncertainty of what the market will look like in 2023, I am being more cautious with companies that make their profit off of lending money to smaller companies that might need that loan just to survive instead of growing their company to then make Main Street Capital money. It could also benefit Main Street Capital by having more companies seize the opportunity to expand or need more cash flow to expand their businesses in 2023, allowing Main Street Capital to purchase large controlling companies it would have not been able to invest into before. In the past month, Main Street is down 1.9% as opposed to VTI, which gives you an idea of what the overall stock market is feeling, which is down 4.4%. In the past year, it is down 17%, but remember, most stocks are down this or even more in this market. The difference is that Main Street Capital has been paying a pretty high yield for its price stability in comparison to similar high yield dividend companies. If you look at Main Street Capital's price appreciation since it went public in 2007, from starting in NASDAQ and now trading in the New York Stock Exchange, it has gone up 145%. Another thing to keep in mind with a dividend paying company is what your game plan is when it comes to retiring. Do you want this in a Roth IRA or in a taxable account? Are you looking at retiring early? When you buy, where you buy it from, and when you want to retire can all change whether or not this is a good company for you. With some price appreciation and growing dividends, how is this company taxed? Most BDCs choose to be treated as regulated investment companies, also known as REITs, for tax purposes, meaning that they must distribute 90% of their taxable income to shareholders. As long as the BDC meets the requirements to be treated as an REIT, it will pay no corporate income tax. Effectively, this is a pass-through tax structure. Instead of being taxed on the corporate and individual level, BDC's profits are taxed just once at the shareholder level. However, it's important to point that BDC dividends are generally not entirely taxable at more favorable qualified dividend rates. Rather, the BDC's ordinary income is taxable at investors' ordinary income rates, while the BDC's capital gains and qualified dividend income is taxed at capital gains rate. Currently, Main Street Capital has approximately 27% of dividends taxed as qualified dividends. That data is predominantly related to dividends paid in the fourth quarter of 2021, and 73% is taxed as ordinary income. So we're talking about most of the dividends given to you by Main Street Capital being taxed as ordinary income, with a small percentage being taxed as a qualified income. Remember, I'm not telling you to buy, sell, or do anything with Main Street Capital, but I think it's a company that you should consider in your portfolio. Although it's a BDC and they are investing in lines of credit that other banks wouldn't consider, it also allows for great opportunities for profit and growth with a well-seasoned, experienced company that has consistently kept growing its revenue, dividends, and portfolio. If you enjoyed the video, please give us a thumbs up, and while you're at it, you might as well subscribe. See you in the next one.